Welcome back to MarketSnap, your daily rundown of everything that moved the markets. Today was one of those sessions where a single stock could have easily hijacked the entire narrative. Moderna absolutely exploded, up a jaw-dropping 177% on a melanoma vaccine breakthrough. And while that's a headline grabber, the real story of the day is much bigger. We're starting there, then zooming out to the bond market, the Fed, and what it all means for your long-term portfolio. It was a day of two halves, really. On the surface, the major indexes closed modestly higher, snapping a three-day losing streak. The S&P 500 and the Nasdaq each added a little over 0.2%, with the Dow and Russell 2000 posting slightly better gains. But the real action was simmering beneath the surface, driven by a massive shift in the bond market and a healthcare sector that came alive. Let's get the headline numbers out of the way. The Dow Jones Industrial Average finished up about 120 points, a 0.22% gain. The S&P 500 rose 0.21%, while the tech-heavy Nasdaq Composite managed a 0.16% advance. The Russell 2000, tracking small caps, outperformed with a 0.50% gain. It's a modest bounce, but it comes after a rough stretch where rising yields were hammering equities, especially the high-flying tech names. Now let's talk about the elephant in the room, Moderna. The stock surged an incredible 177% in a single session. This wasn't just a pop, it was a paradigm shift for the company. The catalyst was positive late-stage trial data for its personalized mRNA cancer vaccine, developed in partnership with Merck. This is a massive validation of the mRNA platform beyond COVID, and the market responded accordingly. Merck itself jumped over 12% on the news, showing the potential of this therapy to be a blockbuster. Beyond the biotech bonanza, we saw a significant rotation into precious metals miners. Agnico Eagle Mines jumped over 11%, and Newmont, Barrick, and Wheaton Precious Metals all posted strong gains of 7% to 11%. This move was fueled by a drop in treasury yields and a weaker dollar, which are tailwinds for gold. It's a classic risk-off trade within a risk-on day, and a reminder that diversification across sectors can pay off. On the flip side, the semiconductor complex continued to feel the heat from the recent surge in bond yields. Lam Research, Dell Technologies, and Seagate all fell between 6% and 8%. The narrative here is simple. These are high-multiple, long-duration assets that get disproportionately punished when the risk-free rate climbs. This is a key dynamic to watch. If yields keep pushing higher, this sector could face more headwinds despite the strong secular AI growth story. So what was the big driver? The bond market again. Treasury Secretary Scott Bessent announced that the Treasury would more than double the size of its debt buyback operations for longer-term securities. This is a direct attempt to rein in the surge in long-term yields that have hit multi-decade highs. The 30-year yield had touched its highest level since 2007, and this move was a clear signal that the administration is concerned about borrowing costs. This is a huge deal. The Treasury is essentially stepping in to support the long end of the curve, which sent yields sharply lower and gave stocks a much-needed boost. But here's the critical takeaway for you as an investor. This is a tactical move, not a fundamental fix. As former Fed official James Bullard pointed out, it doesn't change the underlying supply-demand dynamics. We're in a new era of capital needs for data centers, reshoring, and defense, and that structural demand for capital is what's pushing yields higher. Adding fuel to the fire, the minutes from the Fed's July meeting were released, and they showed a central bank that is growing increasingly restless about inflation. The minutes revealed that more officials than the three who formally dissented favored a rate hike, and many indicated they would support one if inflation doesn't improve. This is a hawkish signal that the market is starting to price in. Fed Chair Kevin Warsh even floated a proposal to reduce the number of FOMC meetings to 6 per year starting in 2027, which would be a major structural change. This puts the Fed in a tough spot. They want to project stability, but the data is pushing them toward more tightening. The market is now wrestling with the possibility of a September hike, something that seemed unthinkable just a few months ago. For long-term investors, this means the era of easy money is well and truly over. We're in a higher-for-longer regime, and that has profound implications for portfolio construction. Let's zoom out and look at the weekly trends. Over the past 5 sessions, we've seen a clear rotation. Energy names like Targa Resources, Synovus, and Phillips 66 are leading the charge, all up between 8% and 11%. This is a direct response to rising oil prices, driven by geopolitical tensions in the Middle East and supply disruptions. It's a reminder that energy remains a powerful hedge against inflation and geopolitical shocks. Conversely, the AI infrastructure trade has taken a breather. CoreWeave, Bloom Energy, and Coherent are all down double digits over the past week. The concern is that the massive capital expenditures by hyperscalers are being funded by debt, and as borrowing costs rise, the economics of that build-out get challenged. This is the tug-of-war between AI fundamentals and leverage that Allspring Global Investments was talking about. It's a risk that could amplify downside if yields keep climbing. Looking at the most active stocks, Oracle was in the spotlight, trading nearly flat but with massive volume. Merck was the clear leader among megacaps, up over 12% on the Moderna partnership news. We also saw interesting moves in Ford, up 4%, and NuScale Power, up over 7%, as the nuclear renaissance story continues to gain traction. It's a diverse mix that shows money is rotating into different pockets of the market. Now let's look ahead. We're in the thick of retail earnings season, and the results so far have been a mixed bag. Target delivered a strong quarter, with comparable sales up 3.8% and a notable jump in traffic from AI platforms. That's a great sign for the consumer, but the bigger test comes later this week with Walmart, Home Depot, and Lowe's all reporting. These names will give us a clearer picture of whether the American consumer is still spending or starting to hunker down. Beyond retail, we have some big tech names on deck. Intuit, Workday, and Analog Devices are all set to report. But the one everyone is waiting for is NVIDIA, which reports next Wednesday. That will be the ultimate test of whether the AI trade can hold up in this higher rate environment. The whisper number is high, so any disappointment could trigger a significant pullback in the entire sector. You can find exclusive earnings transcript summaries on MarketSnap to get ahead of these reports and understand the key metrics and management commentary that matter most. Let's wrap up with the sector action. Energy was the clear winner this week, up 2.3% as oil prices continue to climb. Healthcare also showed resilience, up 0.4% on the day, driven by the biotech surge. On the flip side, we saw weakness in more cyclical areas like basic materials, technology, and industrials, all down over 2% on the week. This is a classic defensive rotation. Investors are favoring sectors with cash flows and pricing power over those with long-duration growth narratives. This tells you everything you